Most people will never ask this question, not because it's complicated, but because they've been conditioned to believe that real wealth, generational wealth, is something reserved for hedge funds, sovereign wealth managers, and the ultra-connected elite. But here's what those people don't want you to figure out on your own. Silver is sitting at $64, $65, $66 an ounce right now. And the number of ounces you need to hold to be in the top 1% of all physical silver stackers on the planet is far smaller than you think. We're going to give you that number today. But more importantly, we're going to explain why that number matters, and why the window to reach it may be shorter than anyone is willing to admit publicly. Stay with me. Credibility build. Let's establish something first. We're not talking about paper silver. We're not talking about SLV, ETFs, silver futures, or any instrument where someone else holds the metal and you hold a promise. We're talking about physical, in hand, allocated, real. According to the Silver Institute, global above-ground refined silver stocks, the kind held outside of industrial use and government vaults, amount to roughly 2.5 to 3 billion ounces across the entire planet. That's the total. That's everything held by every retail investor, every private institution, every family office, every collector, every stacker from Mumbai to Melbourne to Milwaukee. Now factor in that roughly 8 billion people are alive today. The percentage of those people who own any physical silver at all, not paper, not digital, not jewelry, but refined investable silver, is estimated at less than 2% globally. So the competition isn't what you think. Most people have already disqualified themselves. The question isn't whether silver is rare. The question is, how rare is your position within the people who already understand that? Most people don't understand this. Here's what the average retail investor gets wrong. They look at silver's price and they think in terms of returns. They ask, will it go up? Will it beat the S&P? Will it outperform bonds over a 3-year rolling period? That's the wrong frame entirely. The people who hold the most physical silver in private hands aren't thinking in those terms. They're thinking in terms of monetary insurance. They're thinking about what happens when the system they've built their lives inside of experiences a structural dislocation that no central bank can quietly paper over, and they are accumulating with that framework as their foundation. The research firm Metals Focus estimates that fewer than 500,000 people globally hold 500 ounces or more of physical silver. In a world of 8 billion people, that's a fraction so small it doesn't even register as a statistical category. 500 ounces. At today's price of $65, that's roughly $32,000 to $33,000 in metal. That's it. That's the entry point to a tier that most of the planet will never reach, not because they can't, but because they don't know it exists. Build tension. Now let's talk about what's happening in the background, because the price you see today is not being formed in a vacuum. The United States is carrying $36 trillion in federal debt. The interest payments alone, just the interest, now exceed the entire defense budget. Moody's recently stripped America of its last remaining AAA credit rating. That's not a warning anymore. That's a verdict. Meanwhile, central banks globally have been accelerating their purchases of hard assets. Gold gets the headlines. But silver follows gold, and silver has industrial demand that gold simply doesn't carry. Think about where silver actually goes right now. Solar panels, electric vehicles, semiconductor wafers, AI data center infrastructure, medical devices, antimicrobial coatings, defense electronics. The Silver Institute projects that industrial demand alone will consume over 600 million ounces this year. Global mining production is struggling to keep pace. The world has been running a silver supply deficit for 4 consecutive years. Not a temporary blip, a structural deficit that is compounding year over year. And here's the part that doesn't make the financial news cycle. The COMEX, the primary exchange where silver price is discovered, has been showing registered inventory levels at historic lows. Registered silver is the metal actually available for immediate delivery. Not eligible, not earmarked, not promised, available. When the paper market is pricing an asset and the physical inventory behind that price is thinning, something eventually breaks. It always has. History is unambiguous on this point. The number. So what is the number? Based on available data from Silver Institute research, stacking community surveys, and refined above-ground stock estimates, holding 1,000 ounces of physical silver puts you in approximately the top 1% of all private silver holders on Earth. 1,000 ounces. At today's price of $65 an ounce, that's $65,000 in metal. At $66, it's $66,000. Pause on that for a moment. Because if silver moves to where some institutional analysts are now projecting $100, $150, $200 an ounce within this decade, the cost of entry to that tier doesn't stay where it is today. Imagine reaching that 1,000 ounce threshold at $65, then watching the price move to $150. Your position hasn't just grown. You've placed yourself inside a category that the next generation of stackers will need to pay 2 to 3 times more to enter. That's not a return. That's a structural position. Smart money vs. weak hands. Here's the psychology that separates outcomes in this market. Weak hands buy silver when it's surging on financial media. They buy at the peak of emotional excitement. They check the price daily. When it pulls back, they question everything. When it stagnates for 6 months, they sell and rotate back into something that feels more active. Smart money does something different entirely. They read the macro environment. They understand the monetary cycle. They know that every major currency debasement in history, every one, has eventually repriced hard assets against fiat money. Not sometimes, every time. They accumulate during the silence, not during the noise. Right now, silver is in a phase where institutional recognition is beginning to intersect with retail awakening. The smart money moved early, quietly, consistently, without fanfare. The retail wave is building behind them. The question you have to answer for yourself is, which side of that timeline are you on? Risk section. Now let me be direct about something, because credibility requires it. Silver is volatile. It can move violently in both directions. In 2011, silver touched nearly $50 an ounce and then spent years below $20. Anyone who bought at the peak and lacked conviction endured a painful wait. There are also macro scenarios where silver underperforms. A deflationary credit collapse in the short term can suppress commodity prices. A sustained strong dollar environment can weigh on silver. Technological changes in solar or EV manufacturing could alter demand profiles. I'm not here to tell you that silver is a guaranteed outcome. No honest analyst would. What I am telling you is this: the supply and demand fundamentals, the monetary policy trajectory, the geopolitical fragmentation of global trade, and the accelerating industrial consumption of silver as a critical technology input, these are not speculative narratives. They are structural forces being tracked by institutions that manage billions of dollars in real capital. The risk of being wrong exists. The risk of being uninformed also exists. You get to decide which risk concerns you more. Visualizing the future, picture this. It is 2028. Silver is trading at $120 an ounce, maybe $150. The dollar has continued its multi-decade purchasing power decline. The federal debt has crossed $40 trillion. The energy transition has consumed silver at a pace that mining simply could not anticipate. The person who accumulated 1,000 ounces at $65 is sitting on somewhere between $120,000 and $150,000 in metal. More importantly, they are in a tier that now costs 2 to 3 times more to enter than it did in 2025. And the people who waited, who said, "I'll get in when the time is right," who needed more confirmation, who wanted to see more certainty before acting, are now paying the premium that patient capital earned years earlier. History doesn't change this pattern. It repeats it. The 1970s, the post-2008 environment, every era of monetary stress has rewarded people who held real assets through the noise. The question was never whether the cycle would come. It always does. The question was always, were you positioned before or after? So here's where we land. 1,000 ounces of physical silver. At today's prices, approximately $65,000 to $66,000 in metal. A threshold that fewer than 500,000 people on this planet currently meet. That's the top 1% of stackers. Not the top 1% of wealth. Not the top 1% of income. The top 1% of people who understood what silver actually is, what it has always been, and acted on that understanding when the window was still open at prices most future buyers will consider impossibly cheap. The monetary system is under stress. That's not a fringe position anymore. That's Moody's. That's the Bank for International Settlements. That's the IMF raising structural debt concerns in sovereign economies across the developed world. Silver sits at the intersection of monetary history and industrial necessity. That combination has never existed quite like this before. The market doesn't reward hesitation. It rewards conviction backed by understanding. And now you understand something that most people watching financial content today will never think to calculate. So here's the question I want you to sit with, and I want you to answer it in the comments below. Are you already in the top 1% of stackers? Are you building toward it? Or is today the day you started thinking about it differently? Drop your stack size below. Not in dollars, in ounces. Let's see where this community actually stands. And if this analysis gave you something most financial channels won't say out loud, you already know what to do.